Hello viewers, welcome to my channel. I'm Hasham. So far two problems I have completed on partnership accounts, main problems. In this video, problem number 3 I am going to explain. So if you want the perfect knowledge, watch the video till the end, don't skip in between. So these problems are very important from examination point of view. These are the basic problems in partnership accounts. So before starting the third problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. So always keep ready the problems. Take the screenshot of the points of problem number 3, then I'll explain. Now, see the third problem. A and B are partners sharing profits in the proportion of 3:2 with capitals of 20,000 and 15,000 respectively. Two partners are there, A and B. Profit sharing ratio 3:2, 3 by 5, 2 by 5. And the capitals are 20,000, 15,000. A 20,000, B 15,000. 5% interest was agreed to be calculated on the capital of each partner. And B is to be allowed an annual salary of 3,600 which has not been withdrawn. So interest on capital is to be charged at 5% on their capital. Apart from that, B is allowed a salary of 3,600. Now, during the year 2005, A withdrew 1,500 and 2,500 B in anticipation of profits. These are the drawings made. The drawings will be taken in the current account and drawings should not be taken in the appropriation account. Then the profits for the year prior to the calculation of interest on capital but after charging B's salary amounted to 10,000. That means already we have charged B's salary. B's salary should not be taken in P&L appropriation account. Already that salary was charged in profit and loss account. Interest on capital was not charged earlier. Now we have to charge. 10,000 rupees is the profit. A provision of 10% on this amount is to be made in respect of commission to manager. There is a manager who is to be paid 10% commission on profit. The profit is 10,000. On this 10,000, 10% means 1,000. So commission is to be paid to the manager 1,000. Now we have to charge. Now, show the partner's account where capitals are fluctuating and where the capitals are fixed quantities and the account showing the allocation of profit. So, three things are asking. First of all, an account showing allocation of profit. This is nothing but profit and loss appropriation account. Then after that, two different cases are there. We have to prepare the partner's capital account if the capital accounts are fluctuating. When the capitals are fluctuating, we are not going to make the current account. All the adjustment will be done in capital account itself. That's why the name fluctuating. And second case where the capitals are fixed. When capitals are fixed, we make another account called current account. In that current account, we take all the adjustment. That is the problem. Now, first of all, we'll make profit and loss appropriation account showing the division of profit. So here, profit and loss account shows a net profit of 10,000 rupees. From this, interest on capital, as usual, every problem we are taking interest on capital A, B. The capital of A 20,000 and B capital 15,000. 5% is the interest rate. So it comes to 1,000 to A, 750 to B, interest. Now commission payable to manager. Remember one point, salary to B is not being taken now. Because it is given in the problem, salary was already charged in the profit and loss account. Now we are not going to make. Now commission is payable to manager. It is given 10% commission on net profit. 10,000. 10,000 into 10%, 1,000. That's all. Now we can easily find out the divisible profit. The total on the credit side 10,000. So 10,000 minus 1,000 minus 750 minus 1,000, you will get divisible profit 7,250, balancing figure. This is the divisible profit. And this profit will be distributed between A and B in the ratio of 3:2. 3 by 5, 2 by 5. So 7,250 into 3 by 5, 4,350. Here 7,250 into 2 by 5, 2,900. This is the division of profit. That's all. Now we'll take the first case, case 1. If partners' capital accounts are fluctuating, fluctuating means we are not going to make current account, all adjustment will be done in the capital account itself. So I am taking two columns on debit side, two columns on credit side, two partners A, B. Here also A, B. The balance, by balance brought down, this is the opening capital given in the problem, A 20,000 and B 15,000. Now we take interest on capital. Interest on capital already we have calculated 1,000 and 750. So interest on capital 1,000 and 750. Salary to B. It is given in the problem the salary has not been withdrawn. It is not withdrawn by the partner. So salary we should take it. Salary 3,600. Remember salary we have not taken in appropriation account because already it is taken in P&L account. Now credit side, salary 3,600 to B. Now profit, share of profit. How much share of profit A and B are getting? 4,350, 2,900. 4,350, 2,900. Apart from the drawings made by A and B, A drawings 1,500, B's drawings 2,500. That's all. Now simply find out the balancing figure, balance carried out. Credit side, if you take the total 25,350 credit side, same total 25,350. 25,350 minus 1,500, you will get 23,850 is the closing capital of A. So 23,850 balance carried down by balance brought on 23,850. We have calculated the closing balance of A partner. Now B partner, take the total on the credit side 22,250. From 22,250 minus 2,500, 19,750 is the closing capital of B. Now carried down, here brought down. That's all. This is the partner's capital account if the partner's capitals are fluctuating. Why the name fluctuating is given? Because beginning of the year his capital was 20,000 and end of the year his capital is 23,850 for A. For B, beginning of the year 15,000 and end of the year 19,750. So changing, that's why the name fluctuating. Now second method is if the partners agree to keep the capital fixed. They don't want to change. The capital will remain fixed from beginning of the year till end of the year. Then whatever adjustment, interest on capital, salary, share of profit, all these things will be adjusted in a new account of the partner called current account. So here, if partners' capital accounts are fixed, then we are going to make partners' current account. So debit side AB, credit side AB. Now we should not take the opening balance. This opening balance we are not going to take because only adjustment. So what is the adjustment? Interest on capital 1,000 and 750. Salary to B 3,600. Share of profit 4,350, 2,900. And debit side drawings 1,500, 2,500. That's it. Now we find the balancing figure. The only difference, we have not taken the capital. We have taken only the adjustments. Credit side 1,000 plus 4,350, 5,350. From 5,350 minus 1,500, 3,850 is the closing balance of current account of A. This is carried down, here it is brought down. Similarly, credit side 750 plus 3,600 plus 2,900, 7,250. From 7,250 minus 2,500, 4,750 is the closing balance of B. That's all. Now capital account. The capital account of partners will remain fixed. Whatever capital was there in the beginning of the year, same capital at the end of the year. So here capital accounts by balance brought down 20,000, 15,000. This is the opening balance. Same total we have taken. To balance carried down 20,000, 15,000. By balance brought down 20,000, 15,000. This is the opening balance and this is the closing balance. No change at all because partners are keeping capital fixed. All the adjustment in the current account. That's all. So this is the end of problem number 3. So inshallah we'll continue the next problem, problem number 4 in the next video.